After our discussion of a variety of economic concepts and principles, now we are ready to discuss the firm's behaviors, which is a very, very important part of this course. Okay, and you probably already noticed that in our previous discussion, the examples we used are most from our real life, right? As a consumers, like, we talk about when we go on the market and trying to shop something, what could be the supply or demand, right? We use a lot of consumers examples because, it's more, it's easier for you guys to understand. It's more accessible to general public, right? Since this chapter and the other chapters we're going to discuss later, we're going to focus on the firm's behavior or the producer's decision-making process. Okay? You might feel like it's a little bit further away from your life, but, I think after some time, like, several lectures or you should feel more comfortable with these. Okay. All right, now let's start with some basic concepts. Okay, and especially a very important assumption we made back in chapter 4. We said that every firm is a profit maximizer. Okay, so here again, it's just an assumption. Okay, the assumption would allow us to proceed with the discussion. Okay, if you don't believe this assumption, you can definitely derive different theories, different models. Okay, this assumption does not mean we economists are too naive to believe that like every firm is truly a profit maximizer. Of course, in reality, you would find some firms, some businesses would like to take more social responsibilities, right? Like they care more about social justice. They care more about the environmental quality or protection, right? Or some firms, they put their employees' benefit before everything else, including profit. Okay. In other words, what they are maximizing is not the profit. Okay. Because the profit is for the owner or the shareholders of the company. Instead, some firms, they are maximizing their employees' benefit. Okay. And we also find that some firms, especially the big firms, they could be corrupt. So what they are doing on daily basis is to maximize their the benefit of the top management. Okay, so again, when we look at the realistic case, there might be different things these companies are maximizing or are really caring about. But in theory, when we talk about the firm's decision-making process, we assume that these firms are profit maximizer. We believe that in the real world, most firms are profit maximizer. Okay. All right. Now let's talk about several basic concepts. The first one is profit. Okay. We would like to know, mathematically, how could we figure out profit? Okay. And of course, a pretty easy way to figure out the profit is to use revenue minus cost. Okay, so revenue means the money the company gets back from the market. Okay, when they finish production, they put their products on the market, get them sold, get the money back from the market. That's revenue. The cost means how much they have to spend producing their products. Okay. All right. Now, to be able to understand the profit maximization process, we have to talk about these two. Okay. The first one is revenue or total revenue. Okay, TR. As we just mentioned, total revenue means how much money the company gets back from the market, right? So here it's pretty easy for us to figure out, the total revenue equals the price per unit times how many units they get sold on the market, right? So for example, if we're talking about a computer manufacturer, Dell, okay? So Dell's total revenue equals the price per Dell computer on the market times how many computers get sold on the market, right? So that gives us the total revenue, okay? Now the cost could be more challenging, okay? And could be a little bit counterintuitive. Okay. Now here, let's briefly look at a financial capital example, okay, to help you better understand what economist means by cost or total cost. Okay. Now this example says you need $100,000 to start your own business, okay, and you find the interest rate is 5%. And there are two options available to you. The first option, you can borrow $100,000 from Regions or any other financial institution, okay, who would like to lend the money to you. All right, so this is option number one. Of course, when you borrow $100,000, you have to pay Regions 5%. That's what we mean by interest rate, right? Nothing is free. We said in chapter 1, there's no such thing as a free lunch, right? You have the access to this $100,000. You can use it because you pay the interest to Regions, okay? Now, the second option, you find, there's $40,000 in your savings account, okay? So you're just gonna, take that money out and borrow $60,000 from Regions. All right. So here we want to ask you which one has a lower cost. Okay. I would strongly recommend you to pause the video and think about this. All right. I would guess some of you would say, the second option has a lower cost because I only borrow $60,000 from Regions, right? So what I have to pay is just $60,000 times 5%, right? And for these $40,000 of your own saving, you don't have to pay interest. That's your money, okay? But option one, as we already said, that you have to pay 100,000 times 5%. So it looks like that option A is more expensive. Option B is cheaper. It has a lower cost. Is that true? Does that really make sense? Now here we have to introduce two concepts. The first one is called explicit costs. Explicit cost means it requires requires an outlay of money. In other words, you really have to, pull the money out of your pocket and pay to someone else. Okay. Another concept is implicit costs. Implicit costs do not require a cash outlay. All right. And here, if you look at the second option, you would find that the $40,000 of your own savings, you're not really paying anybody else, right? So this is your implicit cost. $60,000 you borrow from Regions, you have to pay 5% of that $60,000. So that's your explicit cost, right? But in economics, when we look at the total cost, it should include both explicit and implicit costs. Why? This goes back to chapter 1 when we talk about opportunity cost. Okay, so if you go with the second option, you use $40,000 of your own saving, you potentially lose the 5% interest you could earn from your saving account. Let me say this again. When you withdraw $40,000 of your saving from the bank account, you lose the opportunity of earning 5% interest on these $40,000. Okay? Again, what we're looking at is potentially what you have to give up to get $100,000 to start your own business. All right? Or another way you can think about this is, with the $40,000 of your own saving, if you do not invest in your own business, you can invest somewhere else. You can buy stocks, buy bonds, or invest in your friend's business, right? Any of these ways, you should earn have some returns from these $40,000, right? But when you invest in your own business, you potentially lose all of these. So for the second option, when we look at the cost, we will definitely include these 5% to the total cost. Okay, 5% of the $40,000. All right. So if you add them up, you would find that the two options would give you the same cost. Okay, would give you the same cost. All right. Now, on the basis of our understanding about the explicit cost and implicit cost, we can talk about two profit concepts. The first one is accounting profit, which is the difference between total revenue and explicit cost. Okay? But the economic profit is the difference between the total revenue and the sum of explicit and implicit costs. In other words, when we calculate accounting profit, we ignore the implicit cost. We just focused upon the cash flow. Okay? If you have to pay someone else, the cash flows out of your pocket, and so that's part of the explicit cost. But for the implicit cost, it's your own money. You're not paying someone else, so we just disregard that. Okay, but the economic profit we factor in implicit cost because there's an extra part of the cost we consider for economic profit. So the accounting profit would usually be higher than economic profit. Okay. Now, this chart gives you another way to show the difference between these two, okay? The economic profit and the accounting profit, okay? Now, here is one example you can find on the worksheet, okay? Now, let me switch to the worksheet number 8, okay? Once again, here, we give you a real-world example, okay? Larry wants to run his own business. Okay, to be able to do that, he has to quit his job working at the quickie loop. Okay, so you find several parts. We already told you like the price, the quantity, so you can figure out the total revenue, right? And these three parts of the costs. Okay, and you also find two more numbers here. If he continued his work at Quickie Loops, he could earn $2,500 per month. If he continues to rent his garage out, he could receive $400 per month. Now think about these two. Okay, should they be included when we calculate accounting profit? Should they be included when we look at the economic profit? we can discuss this during our Zoom meeting.